In Beating the Street, Peter Lynch offers a treasure trove of insights for anyone looking to succeed in the world of investing. This book is a comprehensive guide where Lynch shares his investment strategies, experiences, and the key factors to consider when choosing stocks. Let's dive into the core ideas that Lynch presents in this enlightening read. One of the first things Lynch emphasizes is the importance of paying attention to your surroundings when making investment decisions. The brands, products, and services we encounter daily can provide significant clues. This is known as the invest in what you know approach. Lynch suggests that the products and services we interact with in our everyday lives can lay the foundation for successful investments. For instance, if a coffee chain you frequent is always bustling and its products are well loved, it might be worth considering investing in that company's stocks. Another critical aspect Lynch addresses is the careful examination of a company's financial statements and past performance when investing. The income statement, balance sheet, and cash flow statement offer investors essential insights into a company's financial health. Lynch stresses the importance of evaluating a company's growth potential, debt levels, and profitability ratios. For example, a company with debts exceeding its income may face financial difficulties down the line. Lynch also highlights the importance of not making emotional decisions when buying stocks. Market fluctuations and media-induced panic can lead investors to make poor choices. He underscores the importance of staying calm during such times and remaining committed to your investment strategy. Thinking long-term can protect against the short-term volatility of stocks. For instance, a company's stock price might temporarily dip, but if the company's fundamentals are strong, the investment could be profitable in the long run. Diversifying your portfolio is another key piece of advice Lynch offers. By selecting stocks from different sectors and risk levels, investors can spread their risk and prevent the entire portfolio from suffering if one investment goes south. For example, a portfolio consisting of stocks from the technology, healthcare, and food sectors is likely to be more resilient against economic fluctuations. Success in the investment world also involves thoroughly analyzing a company's management team and leaders. Lynch points out that successful companies are often led by visionary and experienced leaders. A strong management team can help a company navigate challenges and foster growth. For instance, a technology company managed by an innovative and risk-taking leader is likely to have a higher chance of future success. Lynch emphasizes the importance of conducting your own research as an investor. Instead of blindly relying on others' advice, making informed investment decisions through your analysis is crucial. Every investor should determine their risk tolerance and financial goals and develop strategies accordingly. For instance, if you're saving for retirement, you might prefer less risky investments with stable returns. Another significant piece of advice from Lynch is to keep an eye on market trends and economic indicators. Factors like economic growth, inflation rates, and interest rates directly impact stock markets. Lynch advises considering these indicators in investment decisions. For example, if interest rates are rising, borrowing costs increase, potentially negatively affecting some companies' profitability. Additionally, Lynch stresses that investors should always have an exit strategy. Knowing how and when to end your investments can help minimize potential losses. When deciding it's time to sell a stock, Lynch suggests checking for any deterioration in the company's fundamental indicators. For instance, if a company's growth is slowing or competition in the sector is increasing, it might be time to consider selling its stocks. A crucial element of Lynch's investment philosophy is understanding the difference between market valuation and a company's real value. The market price of a stock doesn't always reflect the company's true value. By assessing this difference, Lynch believes it's possible to identify undervalued stocks and make gains. For example, a company with a low market valuation but a strong business model and solid financial structure could present a significant opportunity for investors. Finally, Lynch speaks to the importance of patience when investing. Successful investments often take time, and patience is a virtue that yields long-term gains. Lynch advises investors not to be swayed by short-term fluctuations and market noise but to focus on their long-term goals instead. For instance, if a stock doesn't perform as expected within a few months, that doesn't necessarily mean it should be sold. Being patient and trusting in the company's core values can reward investors in the long run. The most important lessons from this book are: 1. Observe your surroundings. The products and services you encounter daily can provide valuable insights into investment opportunities. 2. Understand financial statements. Carefully examine income statements, balance sheets, and cash flow statements to gauge a company's financial health. 3. Avoid emotional decisions. Stay calm amid market fluctuations and remain committed to your long-term investment strategies. 4. Diversify your portfolio. Balance your portfolio by selecting stocks from different sectors and risk levels. 5. Evaluate management teams. The role of management is crucial to a company's success. Opt for companies with visionary leaders. 6. Conduct your own research. Make informed investment decisions by conducting your analysis instead of relying solely on others' advice. 7. Monitor economic indicators. Shape your investment decisions by considering factors like economic growth, inflation, and interest rates. 8. Have an exit strategy. Plan how and when to end investments to minimize potential losses. 9. Understand market versus real value. Evaluate the difference between a stock's market price and its true value to seize opportunities. 10. Be patient. Patience is key for long-term gains. Don't let short-term volatility dictate your investment decisions.